What happens when a stock either gaps against you or gets away from you, and you're in this case, a put option position, and you end up in this situation where, well, crap, I missed my exit on this. What do I do at this point? Okay. Well, one thing that you could do is just sell your puts. Right? You could sell the puts that you bought, and you will take a loss on that position. But you won't take more of a loss if it continues to go higher. Everybody with me there? So that's one thing that we could do on price action. We could just say, okay, well, I'm going to get out because we're crossing the 5 moving average. Or I'm going to get out, earlier today because we crossed this moving average. The other thing that we can do, though, is we can go in and we can say, okay, how do I hedge this out? How do I protect myself? How do I use spread trades as a way to convert my directional trade and tactically reverse this position so that I'm able to lose less and actually potentially make some money? So let's just go in and let's take a look and let's see. Let me put it on the board here and draw it out for you guys so that you guys will be able to see what we were doing there. Okay. Yesterday, stock was going lower. We bought put options at the 1240 strike price. Okay, so we bought to open the 1240 put option and paid $10 for it. We'll just call it $10. Makes it a nice round number. All right. So we bought the 1240 put option because we thought the stock was going down. Well, we saw the stock going down. The stock was going down. And so the stock was going down. We were profitable on that yesterday. Things look good. Today, the stock rips higher. And either you missed it, which I'm going to say if it was a real funded trade, you probably wouldn't have missed this one, right? This would have been you're watching every minute of it and you're looking for that exit above yesterday's opening price. So the stock turns around and goes up. You either miss it or it gaps up, okay? And the stock rallies higher and is trading, we're at here on this one today. 1254. Okay, so the stock is trading higher. So you're looking at the stock and you're saying, man, I bought put options on this thing. I thought it was going to go lower, and now it's gone higher. I'm looking at the chart and I'm thinking, yeah, we're still bearish. We're still below that 5 moving average. It could still move lower, but I don't want to continue to lose if I'm wrong, right? Because that $10 option is going to go down to like $5, $3, $2, and 0. We could sell our put option. We could just get rid of the put option. We could say, you know what, I'm just going to sell this for whatever I can get out of it. Maybe I save $6 or $7 off of the $10 that I spent. Well, the other thing that I can do is sell somebody else's put option. Not sell my put option, but guys, if I go in as that stock is going higher and I sell to open the 1237.50 put option, and I can sell that for, I don't know, maybe I can sell that for $5. Okay, I sell this for $4. Now, I'm selling a put. Do I have an obligation to the market maker when I sell the put? Yes, I do. What is that obligation? My obligation is that if the stock is below 1237.50, I will have to deliver the stock, take delivery of the stock from the market maker. He's going to make me buy it for 1237.50. Well, that would suck, wouldn't it? But I have the right to force him to buy it for me for 1240. The difference between those two is 250. So even if the stock drops, if it turns around, if it doesn't, if this rally that we've got today, right, we went down yesterday, and then we go up today, and then, on Friday we go down. There isn't any inherent risk as a spread in this case, because if it's below 1237.50, he's going to make me buy it from him, but I have the right to make him buy it from me at 1240. So the transfer of the stock from one to the other really it requires no risk to me because the structure of this trade is a debit spread. This is a debit spread, different than a credit spread. We talked about credit spreads yesterday. This one, if the stock goes down, doesn't put me at any risk. If the stock continues to go up or if the stock goes sideways, what is going to happen to this option here? It's a put. If the stock goes up or sideways, it would expire worthless. It would lose value. Okay, if we get to expiration day and it's worth 0, we would make $4 there. Everybody with me? What about this option up here? Oh, it would also expire worthless, wouldn't it? Right? So as the stock goes up or sideways, the put options are losing value. What I've done is I have gone in early in the week and I have reduced my risk. I have reduced my risk because if the stock does go up or sideways, I'm at least making money on one of my 2 trades. Now, let's say that we do this on Tuesday, right? We go in, we sell the put option on Tuesday, and we bring in that money. And then on, I don't know, maybe on Thursday, the stock tops out, hits an area of resistance, and begins to come down. Could I not buy back this put option for maybe 50 cents or $1? Could I not buy that back and put a couple dollars in the bank? Now understand, I'm losing money on the other put as well, but now that the stock is coming down, what I don't want is for the value of the put to go up on the one that I sold. If that stock, and Priceline is the kind of stock that can do this, guys. I've been in these kinds of spreads where I've used a spread to mitigate my risk through the week and had the stock move $30 in favor of my trade on Thursday and Friday. Okay, so it's certainly the kind of stock that can go way out of the money and then come right back in the money. So if I do that, if this stock starts to go down on Thursday and Friday, and let's just say that it goes down to 12, oh, I don't know, let's say it goes down to 12.35. Well, I got bad news for you. You're gonna lose. You're still gonna lose money on that 12.40 put, even though the stock came all the way down. You're still gonna lose money on it, right? Because that put on expiration day would only be worth the intrinsic value, the difference between stock price and strike price, of $5. Okay, is everybody with me there? So you're still going to lose $5 on that trade. What if you brought in 3 on the other trade? Well, now you've taken what could have been a $10 loss and you've converted it into a $2 loss. All right? So that's scenario number 1. The stock goes up, it goes down, and you know you sell one option, you make some money on it while it's going up, and then you buy it back once the stock starts pulling back, and if it goes far enough, you can actually get to a place where you're losing less. Okay, grief. Does no one have my schedule today? Hold on a second, guys. Okay. Scenario number 2. We do this on Tuesday, right? We sell this position. The stock goes up, and it doesn't look like it's going to come down, right? This thing just powering higher. So on Wednesday, could I come in and buy back this position, put $2, $3, $3.50 in the bank, right, on Wednesday, and then roll up into now a credit spread? So now on Wednesday or Thursday, I could sell to open, as an example, the 12.45 put option, and I might bring in, because this one will be closer to the money, bring in more money, I might be bringing in, oh, I don't know, let's call it $6 on this. Am I naked in the position anywhere? Have I got a naked put anywhere on this trade? I do not. I am not naked in the position. As long as the stock is above 12.45 at expiration, I will get to keep the $6, which means that if that's all I did, I would make perhaps $3 here, and the earlier position, the one that we had from Tuesday, I'd make $3 over here, put that in the bank, make $6 here, put that in the bank. Well, now this has turned into a $1 loss because I understand how to use a spread and roll that spread to create accumulating profits that count against my accumulating losses in the long position. Well, that's pretty cool, but if you guys remember, yesterday I talked about why I don't like spreads, credit spreads. You guys remember we had this discussion yesterday. Your risk reward is inverted, and I'm not a big fan of that. I don't want to have inverted reward to risk ratios here, but I'm using this spread as a hedge. I'm not using this as a cash flow opportunity. This is oh crap, I've crashed the car into the wall and get it down into the pit stop, and the guys are pulling the fenders off of it and cutting away as much material as they can just to get the car back out on the track. Well, here's the deal, guys. If I've got a bull put credit spread, which is what this is a bull put spread down here, I am exposed in this case to $5 of margin requirement. My broker's going to require, because this one doesn't actually give me a credit, my maximum risk in this is $5. He's going to require a $5 margin on that. But let me ask you this, if the stock starts to slow down, if it starts looking like it might go a little bit sideways or not go up as fast, could I come in, since I already have a bull put credit spread, and sell a bear call credit spread up above? Can I do that? Can I have a bull put spread and a bear call spread at the same time? Answer is clearly yes, you can. And the beauty of it is, if this spread is also $5 wide, I buy to open the 1260 call option for $4, I would be bringing in a net credit of $3 on the top side, yes? Everybody with me so far? If you're not, let me know, and I will answer your questions and encourage you to watch this in the archive several times. So if I did this, right, this position right here, I did this one on Wednesday, right? This was Wednesday. Remember, we made $3 by doing our position over here on Tuesday. And if we did this one over here on Thursday or Friday, well, actually Thursday or Friday, I'm now starting to accumulate credit, taking what was a directional position and turning it into a spread. And in fact, turning it into multiple spreads. So I've rolled from a debit spread to a credit spread to an iron condor at this point. Well, assuming it all works out, assuming that it all works out, I made $3, $6, and $3, that's 12, and I lost 10. Absolutely. Jose says, if the stock keeps skyrocketing, could you just keep rolling up the put that you do, sell a higher strike price, and not worry about the bullish spread? Here's what I'm going to tell you, Jose. Not only would I do that, at that point, if the charts justify it, makes perfect sense for me to go in and aggressively buy calls in addition to the spread. Okay, does this make sense? Is anybody confused here on this? This is an idea that I call dynamic hedging. We are dynamically hedging the position. We're hedging the position in very much near real time, right? We're taking the chart, we're reading the chart, we're evaluating what the stock is doing, and we're selling positions to create some revenue to offset the losses that we've taken, because either in this case, Priceline got away from us. If it's a real Priceline trade, I guarantee it does not get away from you because you got your finger on the trigger the whole time. But it, or something happens, news happens, it gaps. You take an unexpected move in the market that moves against your positions, and now you're like, well, now we've got to break out the hammer and the shovel and get to work. Now the work starts, right? And it can be some work, but the idea is to create first low-risk income revenue to offset the loss in the form of a debit spread, and then turn that into a credit spread when it's appropriate. And as long as I'm going to have a credit spread, turn it into an iron condor so I get both sides. Because, guys, the stock cannot be above this and below this at the same time on expiration. So there's only $5 of margin on this whole trade. And I know some of you guys in here that have come to Better Trades through the Mastermind Traders Group, you were taught over there to use a spread and to set it up in such a way that if the trade went against you, you could turn it into a directional trade. All we're doing here is the inverse. I would rather take a directional trade first, and if it doesn't work out, then turn it into a spread. Why do I like the directional trades first? Why is it that 90% of what you see me doing here has been directional trades? Because you're not capping the potential profit, right? That's where the big money comes from. That's where the big money in trading is trend and swing trades that are directional in nature. So that's where we want to find those opportunities. That's where we want to find the biggest money, right? The most efficient use of our money. And it says, you know, you make more money, and you're right, you do. But it's that efficient use of my money is how I look at it, right? You know, we talked yesterday, I had a good discussion yesterday about why I despise. You want to know why I despise credit spreads? Because I've done this. I've done this exact thing, and it was brutal. Traded credit spreads for a while. Bought a credit spread on Google, okay? And it was a bull put spread. Stock was going up. I made money. This was back in the bad old days when we had $10 wide spreads and only had monthly expirations. So I did a credit spread. You had it on for 2 or 3 weeks typically, and you'd make $1, maybe $1.50 on a $10 wide spread. It was awful, right? So because of the risk. Well, I did it. I made $1. That was pretty good. I did it the next month. I made $1. And I was like, this is awesome. I did it again the next month. Made $1. You know, and I'm talking. I was doing 10 contract lots back at that point, and so I was excited. I was making $1,000 a month on these spreads, and I thought, well, this is pretty good. I mean, I've never had 3, 4 trades go for me in a row. I'm going to keep doing this. Overnight, Google got kicked out of China. Right? Bad news for Google. The stock gaps down, and I get crushed on my spread. I lost $10,000 on that spread. I'd made, whatever it was, 2 or 3,000 in the 3 months before that. So 4 months in, now I'm down $7,000, which, I mean, that'll piss you off. So much so that I was like, well, I'm going to show them. I'll do a bear call spread now that they got kicked out of China. And I made money 1 month, and I made money another month, and was about to make money the 3rd month, and guess what happened? Google gets let back into China. Overnight, the stock gaps up all the way through my spread. Nothing I can do about it. No hedging, no nothing. There's nothing you can do about it at that point. And I got killed for another $10,000 loss. Right? So if you're losing 20 and you're making 5, how's that going to work out in the course of 4 months, 5 months? Yeah, it sucks. So I don't like these. I don't like them. There's too much. Now, I said I don't like them unless it's at or very near expiration. I love these on expiration because it's a great way for me to just pick up money that the market makers are leaving all over the floor every single day. You can make it work. Here's the thing, guys. I mean, the example that I gave you yesterday, Greg, is exactly what you're talking about. You make money, make money, make money, make money, make money, take a loss, you're still ahead. Right? Does everybody see that? Everybody see how that works out? That is what spread traders will tell me. They're like, okay, you make money, 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 and then it doesn't work and you're still ahead. Because you're so much more likely, arguably, statistically, this is the argument they make to me, you're so much more likely to make money on the credit spread than you are to lose it, and you are, right? But the thing is, when you lose, the losses eat up so much of the profits. I don't know about you guys, I'm working too hard for this. I don't need them coming in and kicking my butt on. So what do we do instead? If you're a spread trader, the idea of a spread is that you are mitigating your risk. Intrinsically built into the structure of a spread trade is a certain amount of risk management. Because even on these, you can't lose more than $4, right? I mean, most you're going to make is $1, but the most you're going to lose is $4, right? Well, if you go in and you buy a $10 option on Priceline, you can lose a lot more than $4, right? I mean, if you don't believe me, I'll show you the numbers right now. That's where we're at. But compare the credit spread to a debit spread, which is nothing more than a directional spread, a directional play on the stock, but you're capping your profit and you're mitigating your risk. So in other words, we see a stock trading at $123 a share. We go out and we say, I think the stock's going to move higher, so we buy to open the 125 call option. We buy to open the 125 call for $2. Okay? Now, we look at it and we go, you know what, I could lose all $2 if I'm wrong. It's an out-of-the-money option. It's all time value, and if the stock does not go above 125 by $2, I will lose money on this trade. Right? I mean, your break-even on this, you guys know how to calculate break-evens. I think you guys do. When I spoke to the mastermind group in Chicago, most of them were pretty savvy on that. 127 is our break-even. Okay, 127 is our break-even. So the stock has to get to 127 or above, or we're going to lose money on this trade. That is what it is. No two ways about it. Well, if it doesn't get to 125, we're going to lose all $2, and if it doesn't get to 127, we're going to lose some. And you might look at that and say, well, that's just too much risk. I don't like that trade. So what am I going to do? I'm going to come out here and sell to open the 130 call option for perhaps $1. You see, I've inverted the spread now from a credit spread to a debit spread because this is going to cost me $1 to do. My net cost, my net risk is $1. Does everybody see where the dollar comes from? I bought an option for $2. I sold an option for $1. My net cost in the trade is $1. Yes, Jim, I am. I'm about to make an announcement on all that. So my net cost on this is $1. Is what it is. Well, what did that just do to my break-even? My break-even has now moved from 127 down to 126. Right? My break-even has moved down to 126. What's happened to my risk? When I bought the $2 option, I had $2 at risk. Do I have at risk now? 1. Professionals focus on risk. Amateurs chase profit. First thing I want to focus on is the risk. I've got 50% reduction in my risk over a directional trade here. Okay, so I've reduced my risk. I like that. But I have capped my profits. You see, if the stock goes to 131 at expiration, the market maker could call the stock away from me, and I would have to deliver it at 130. I would have to buy the stock at 131 and turn around and deliver it to him at 130 because I sold a call option. Oh, but wait, I also bought a call option. So if he calls it away from me at 130, I will call it away from him at 125, deliver it to him at 130, and I will make $5 on that transaction. Does everybody see where the $5 comes from? $5 is my max profit on this, and it's actually not because I spent $1. So my net max profit would be what? $4. Well, hang on a minute. Shut the front door. Look at what we've just done. We have taken the 4-to-1 risk to reward scenario that we had in a credit spread and inverted it. We now have a 4-to-1 reward to risk ratio. keep in mind, Greg, those numbers are cumulative, right? In which, yes, I'm not arguing. And here's what I'm going to tell you. I love using spreads when I need to as a hedging technique. I love using them on expiration day when the odds are in my favor, but a 4-to-1 risk to reward ratio is not something that I'm remotely interested in being in more than a few hours. Okay? Now this 4-to-1 reward to risk ratio, well now let's use the same kinds of numbers that we did yesterday. Let's say you did this on 10 trades and you're wrong 70% of the time, right? So you lose $1, you lose $1. Doesn't this suck? You know, they're like, man, this is freaking awful. 1, 2, 3, 4, 5. There's another one. Oh, lost another $1. Just y'all suck at this, right? I mean, so here we're like, oh, yeah, that's awful, right? So 7 times you lost $1, right? You did 10 trades, 70% of the time you were wrong, and you only were right 3 times. Somebody do the math for me here, because you all know I'm not good at math, right? How did we come out? Being wrong 70% of the time. Okay, Jose did the math for me. He says you're up. Yo, as good at math as I am. $12 there. I figured that out. And we're down 7 here. So how much are we? Does that help? 12 minus 7. It'd be 5. You are net positive $5, and you were wrong 70% of the time. Well, I'm good at being wrong. And if I'm wrong, I'd rather that I'm losing the small amount instead of the big amount. And that is the problem with credit spreads. It just is. If you talk to professional option traders, if you talk to, if you guys watch any of the options action shows, those guys, they hate doing credit spreads. They're loath to do a credit spread. They really are.